Well, last week brought another blowout non-farm payrolls number, a further round of hawkish Fed rhetoric and renewed geopolitical worries hitting financial markets as well. And all of that combined saw selling in the equity market, drove gold to a fresh record high, permitted the dollar to remain relatively firm against its G10 FX peers, and also took Treasury yields to fresh year-to-date highs across the curve. Another busy week lies ahead for the financial markets this week. The latest US CPI data, by far and away the macro highlights, but we also have three G10 central bank decisions to get our teeth into as well, and of course the start of Q1 earnings season on Friday over on Wall Street. Plenty for us to discuss on the Trade-Off UK this week, so without further ado, let's get into the show. So it was a busy week of data and news flow last week, and a tumultuous roller coaster ride for the financial markets as well. And it looks like there's little sign of things slowing down as we move into what is promising to be another very, very busy trading week ahead. Joining me, as always, to try and work out exactly what's going on and guide us through current developments is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. How are you? I know you were out looking for the eclipse earlier on. I'm glad you've come in to grace us with your presence and given up the sort of amateur astronomy for half an hour or so.
Yeah, no chance of seeing the eclipse with the cloud we've got at the moment. So, sticking that one in the bin for another 30 years until we get the next one. I'm all good. Looking forward to this week. It's a bit of a surprise. Usually the week after NFP's quite a dead one. But as you say, we've got these central banks coming up, important data from the US. So lots to get our trading teeth stuck into, I think.
Indeed, yes, plenty. So why don't we crack on right away with Topical Thunder? I was just thinking, I always get astronomy and astrology confused. I guess the way to remember it is astrology is basically the same as technical analysis, but just viewed through perhaps a different lens. In any case, let's have a look at some of the key topics that are driving markets at the moment. I want to have a chat about the US economy, first of all. I know you're going to touch in more depth on CPI in a moment, but I want to talk about the non-farm payrolls number first of all, because we had another blowout non-farm payrolls print on Friday. Headline payrolls rising by around 303,000 in the month of March, well above the 214,000 consensus, and also well above the top of the forecast range, which I think was around 285, 290. That figure was helped by a 22,000 upward net revision to the prior 2 months worth of data. So really no sign that hiring in the United States is slowing down anytime soon. In fact, the 3-month average of non-farm payrolls gains now stands at 276,000, which is a 12-month high. The details of that report were promising as well. Unemployment coming down a little bit to 3.8 from 3.9% previously. And importantly, that came as the participation rate rose back towards the cycle highs that we saw towards the middle of last year, up to 62.7 from 62.5%, and average hourly earnings still of very little concern, rising 0.3% on a monthly basis. I think what is important is just some context around the report, and we have to go back to the March Fed press conference for this, where Chair Powell stood up and said, one of many things he said, of course, was that strong hiring by itself is not a reason to delay rate cuts. So perhaps some of that hawkish repricing that we saw over the last week or so on the jobs data, particularly in the aftermath of the payrolls number, a little bit overdone perhaps, given that the Fed seem much more focused, and arguably rightly so, on the inflation side of the dual mandate rather than on the jobs side. So I'm not going to go into inflation too much, because obviously Ryan's going to touch on that in a second. But I guess the question I've got for you, Ryan, and for anyone who wants to answer it in the comments as well, is you look at the US economy at the moment, you've got pretty much full employment. You've got 300,000 jobs, as near as makes no difference, being added on a monthly basis. You've got the ISM manufacturing PMI back above 50 at an 18-month high. You've got the services number considerably north of 50 as well. A decent JOLTS report last week too. ADP, yes, it's nonsense, but that beat expectations as well. Why do the Fed need to cut if the economy and the data that we're getting looks this good?
That is the big question indeed. And I know a lot of people are brushing this NFP report under the carpet because everyone wants to look at inflation, but there's still been enough from the numbers within the report to suggest that there are inflation pressures. Year-on-year wages still sticky above 4%, a bit like inflation, hasn't really moved from there. So there's plenty going on. And also, yeah, we've had improvement in the PMIs, but also the employment numbers in those PMIs have been softening a bit. So that has been at odds with some of the numbers in the jobs report. So I saw a lot of people questioning the state of the data, the jobless claims data, the NFP data. Is it being measured right? Is it being accounted for right? Oh. Who knows? We all trade the numbers that's given. And at the moment, inflation's not coming down. Jobs are looking strong. The economy is looking strong. And so you're right. What is the need to cut? And that's what we're seeing in the market. It's shifted rate cut expectations again. Now we're mainly pricing 2 cuts. At the beginning of the year, we were pricing 4, 5, even 6 cuts, and the market's come all the way down. So, yeah, there's no reason for the Fed to go into a cut cycle, but they can't have rates up this high. That's the long and short of it. And higher for longer is fine until it becomes higher and longer. Then it becomes a bit of a problem. So it's another rock and a hard place for the Fed to be in.
Indeed, yes. And actually, it's not just higher for longer, it's even higher for longer when you look on a real basis, of course, because as inflation continues to come down, the relative policy stance tightens, real rates can continue to move higher. I do wonder whether the Fed have boxed themselves into a bit of a corner here. I saw earlier on LinkedIn, forgive me, I can't remember who this was from now, so I can't give them credit. But it's effectively saying, perhaps the only reason the market is betting on the Fed cutting this year is because Powell has said they're going to cut. If you look at the data on its own without any of the Fed speak or commentary around it, you really can't point to anything that says, yeah, you need to deliver a rate cut. But personally, I think they'll probably still begin policy normalization in the summer. The other consideration, of course, is if every other central bank is easing, then they're not going to want to be the ones left behind and running a much tighter policy stance. But we'll get on to those other central banks in a second. I touched on inflation a few times. Why don't you dig into the CPI numbers that we got coming up on Wednesday in a bit more detail?
Yeah, certainly. And to echo your thoughts, this is potentially more sleepless nights for the Fed. The US CPI, it tops the bill this week as far as the data goes. And, we've got some Fed heads who are already wavering about rate cuts, and this data could spur more. Last week, both Kashgari and Goolsbee warned even that rates might not be cut at all if inflation stalls. We had Barking worried that early 2024 data was less encouraging and raises the risk of whether the inflation outlook is shifting. Logan on Friday said that the Fed should remain prepared to respond appropriately if inflation stops falling, and that in essence means more hikes. These fears, though, have not been explicitly remarked upon by Powell in recent comments, but another hot inflation report this week is going to get the market thinking about less cuts, and maybe again, even some people, raising the prospect of more hikes. Now, we know it never takes much for the market to go running too far the other way. It likes to either be ultra dovish or uber hawkish. So it's not going to take much of this data to go the other way. CPI, as mentioned, expected to jump 2 pips to 3.4% from 3.2%. The core, though, is expected to fall a pip to 3.7 from 3.8. Now, inflation took a year to go from its June 2022 peak at 9.1% down to 3%. And that was in June 2023. Since then, it's been above 3% for 9 months. With this month, we'll be making it the 10th if it comes in as expected. Now, I don't know about you, Michael, but that's not progress on inflation in any central bank playbook. Oh. So, as we said, the Fed have had a credibility problem since inflation first arrived. They face another one now if inflation stays sticky, and it won't be long for before the market lets them know that. So I'm going to pop the question back to you in what do they do if inflation doesn't start coming down again towards target?
I'm going to take issue with that, actually. It won't surprise you to learn. I agree with the initial part of what you were saying. Yes, indeed. Next Thursday. I agree with the initial part of what you were saying around CPI. And I think context is key. We have had 3 straight headline prints that have been hotter than expected. So that is obviously a concern. I think 3 is probably pushing the limits of what you can dismiss as noise. If you start to get 4 or even 5 next month, then policymakers are going to naturally have to acknowledge that. I think there are a couple of things I would acknowledge, though, and I guess this is sort of the same point. The first is that the rise that we're expecting in inflation from 3.2 to 3.4 in March, that is going to be mainly driven by energy prices, primarily driven by gasoline prices. Not only have we seen crude move higher, as we've been discussing at some length on the show, there's also a seasonal impact here. We're moving in towards the start of driving season in the United States, and we do tend to see gasoline prices, fuel prices move higher at this time of year, if you go back and look at the data. What I really want to pick up on, though, is what you're saying around there having not been any progress. And I disagree. I think there has been some progress. If you look at core inflation, for example, the March 2023 core was at 5.6. We're now talking about core coming in at 3.7 this March, a year later. Clearly, the progress hasn't been as rapid as it was going from double digits down to sort of the high low 3% range. But progress is continuing to be made. I think that core disinflationary trend is intact, and I think what the Fed are really watching and what policymakers around the world are watching is two things. One is core inflation, which continues to move lower. The problematic one is services inflation, which isn't moving particularly lower at the moment. And if you get a problem, as we seem to be perhaps on the precipice of at the moment, where services inflation continues to go nowhere, goods inflation has come down massively. If we're now talking about higher commodity prices, shipping delays, higher transport costs, et cetera, are we going to see goods inflation turn around? And is that going to push headline and core inflation higher on an overall basis? I think that's the key worry for me now. But there is clearly progress being made. I think the question is, to what degree is that progress impeded by potential further supply shocks, whether they emanate from the Middle East or somewhere else? So forgive me for answering your question with a question, but hopefully that clears up my view at the very least.
Not really. I'm going to counter your counter quickly by saying that the core always lags the headline number by quite some margin. And so, if the headline's not going anywhere, I don't expect the core to keep coming down below the headline number. I think we're going to see the same effect coming in the core soon. All I read in the PMIs, in the ISM, the reports, it's prices. Prices are still going up, whether it's input costs or output costs or wages. We've heard about the Fed members. They're very worried about, as you said, service inflation, the housing, rents, and all shelters inflation that's still surprising them and not coming down as expected. So I think there's still plenty of in the pipe. And if headline inflation doesn't come down, that gives people on domestic price front no reason to lower their prices. Then you lose that disinflation in the core. But it'll be interesting to see in the months ahead who's going to be right and who's going to be wrong.
Yes, it will indeed. No, be me. The final thing I would just say on this is a very interesting discussion, but perhaps slightly immaterial, because the Fed don't really care about CPI. They don't care about PPI either, which we've got later in the week. What the Fed are looking at is the PCE and the core PCE data, of course, that we will get out towards the end of the month. Normally the final week of the month we get that data. But there are boffins out there, and sadly I'm not one of them, who can extrapolate from the CPI and the PPI prints a pretty decent idea of where PCE is going to be. So although because we get the CPI data first, it's the one with the most market impact, it doesn't have as much of an impact on policy as the PCE figures that we get a little bit later on the month. But we'll cover those in due course. We do need to move on, and we need to move on to the ECB, because Christine Lagarde and co. taking centre stage on Thursday for the April ECB decision. The focus, of course, will be not only on the shade of Christine Lagarde's tan at the post-meeting press conference, but also what the ECB have to say in terms of their policy guidance. In March, it was very interesting, and it was very, very clear what the ECB were trying to do. And we heard from Lagarde, not just at the press conference, but also in many appearances afterwards, and many other ECB speakers besides, repeating a variation of the line that they will know a little more by the April meeting, but that they will know a lot more by the June meeting. And in many ways, and perhaps every way, that was the ECB pretty much pre-committing to kicking off the easing cycle at their next meeting in June. So we're not expecting any policy shifts this time around. The data since that March meeting has actually been relatively interesting, or at least interesting by Eurozone standards. It showed that disinflation has continued on a relatively rapid basis. CPI coming down to 2.4% in March from a prior 2.6%. Of course, remember, that the ECB's projections didn't have, they were released in March, of course, they didn't have CPI hitting the 2% target until the third quarter of 2025. Well, it looks like we're going to get there a hell of a lot sooner than that at the moment, which obviously helps to open the door to beginning to normalise policy. But at the same time, we've seen that some of the PMI figures have started to point to the economy beginning to bottom out. The composite PMI now back above 50, although, of course, risks do continue to tilt to the downside, given fragility that we see in China, and also given the ongoing situation in the Middle East, to which the Eurozone remains relatively exposed. So we may get a further dovish shift this week. I think we may get a line along the lines of the ECB having almost sufficient confidence in inflation getting back to target in order to deliver the first rate cut. I don't think we're going to get anything particularly more explicit than that. Certainly not along the lines of what we got in June of 2022 at the start of the hiking cycle, when the ECB effectively and explicitly said, we will hike 25 basis points at the July meeting. I don't think we're going to get an explicit pre-commitment like that. But in any case, if you look at Eurozone rates markets, the OAS curve pretty much prices a 100% chance of a cut in June, and it prices around 90 basis points of cuts in total this year, effectively 4 rate cuts. So I don't know about you, Ryan, but it feels like the bar for a dovish surprise from the ECB might be a relatively high one.
Yeah, very much so. I think that 90 pips for the total for this year might be a bit too far on the dovish side. I don't think they're going to be in a rush to cut. CPI, that number getting close to target. A lot of central banks talking about, they're going to start cutting when they're approaching their target, not when it gets to target. So 2.4%, we're in the ballpark with that. So yeah, I expect this meeting to be a communication meeting. It's probably a little bit of a trade-off between the doves, some of which who wanted that
trade-off. Very good.
There we go. See, slipping in the lines. Some of the doves who actually wanted action at this meeting. So this will probably be a meeting where, as you say, that confidence line that a lot of central banks have been using, it's almost like the old Trichet vigilance and, proper vigilance, or whatever he used to. Strong vigilance, that was it, that he used to use to indicate action. Yeah, it's probably going to be one of those where they indicate that they have more confidence that they're ready to cut. It should be noted, though, that although a lot of people have been talking about June cuts and ECB members in particular, not many of them are saying we will be looking to cut in June. They're all saying June is the date where they may make a decision. So haven't been themselves saying, yep, we're cutting in June, even the biggest doves. But, this is the moment. And I don't think if they derail that, if anything derails that, then the market's going to go a bit potty because, the can will get kicked. So, yeah, I think it's all about setting up June, this meeting. And if they say anything that doesn't set up June, then I think the euro is going to fly.
Indeed, yes. Although I think it is near certain they will set up June, but we do need to be aware to the risk nonetheless. I guess the more interesting question with the ECB is, what do they do after June? Do they then cut in July? I think the doves are going to be pretty pushing for that one pretty hard. Do they cut once a quarter at a forecast meeting? I don't think we're going to get any clarity on that this week. That's probably a question for after that first rate cut has been delivered. But I think that's very quickly where the debate on the Governing Council is going to shift to. And of course, one thing that I didn't mention, I was very remiss of me, as is always the case with ECB meetings, not only the statement, not only the press conference, but we also need to look out for the sources stories that tend to pop up shortly after the press conference as well, to tell us what really went on in the room and what the hawks and doves were really thinking and trying to argue for. So not just around that sort of 1-2 o'clock hour that we could see some volatility in the euro all through the afternoon as markets wait for those stories as well. But we shan't talk about the ECB any longer.
Oh, I was going to talk about the ECB for a bit longer, but
go on.
I'm just going to mention last month there was a bit of a departure. We didn't get the sources piece the same day; we got it the next day. So we thought Lagarde had made her mark in stamping out the leaks, and no one promised to release anything the same day. They released it the next day instead. So just bear that in mind for this week.
Indeed, that is a good shout. In any case, let's go on to our last topic.
Yeah, last topic to talk about is risk, and really how some headlines can change what happens in the market. We had a reminder last week that it doesn't matter what a market is trading 1 minute, as it can be flipped on its head in an instant. Early last week, we had US stock markets making all-time highs, and then the Israel-Iran headlines dropped in the latter part of the week, and it really sort of turned over the apple cart. We saw US assets get sold, stocks get sold, gold motoring to fresh highs, while yen, Swissy, and all went bid. It's been a while, but it was a good old-fashioned risk-off type move. Now, in moments like that, it can be hard for traders to adjust quickly. If you're on the right side of such moves, then they can obviously be very profitable. But if you're on the wrong side, they can be damaging. So when we get moves like that out of the blue, it's important to know how to react. The first thing to do is to ignore, your short-term or nearby tech levels and focus on the wider, bigger levels. It can also pay to maybe just sit out the market for a little bit until things settle down and trends can resume and the picture just becomes a little clearer. For instance, I would have liked to have bought a dip in S&Ps, but I wasn't going to do that going into that last weekend, where the Iran risk was still relevant, and it still is to a certain degree. As it was, we saw rebounding stocks after the US asked Iran nicely not to hit any of its targets, which potentially keeps them out of any conflict that may happen. So if the situation calms down, one needs to look at what's been affected, what markets have been affected. Oil rallying may not be so quick to pull back as it was going in that direction anyway, as was gold. And as we've seen today, gold's still up in the highs there. Yen, Swissy pairs may get back to weakening. We're seeing that with dollar yen tapping up that 152 again today. Though this event really hasn't forced them the other way too much. So if you know where the trends were going into these sort of events when it kicked off, and then those headlines kick those moves out of sync, if you like, you know what to trade after. So have a look around the pairs, have a look around your assets, have these sort of risk headlines moved things significantly out of kilter. And if they have, then you can expect the trend to resume once these things sort of die down.
Absolutely. Very well put, as always. I think last week was interesting. As you said, it was perhaps an overdue reminder that, markets are not immune to geopolitical risk and to geopolitical headlines, and we can have those days where classic risk-off trading goes into effect. I saw a stat actually on Friday morning. This came via Bloomberg's Cameron Kreis, who, if you have a terminal, read his daily column. It is brilliant. And he was saying that actually Thursday was the first down day for the S&P 500 with a greater than 2% intraday range for about 14 or 15 months, which is perhaps a reminder again of just how subdued conditions have been while the market has continued to head higher. But you're absolutely right. It does speak to not only the need to remain agile and on top of market themes, but also on top of key trends. So that, as you rightly alluded to at the end there, when these headlines do fade, when the market's perception of risk begins to dissipate, you're aware of what the market was doing previously and can get back in if you so desire and if conditions remain appropriate to do so.
Yeah, very much so. And, we've still got the ongoing war, Ukraine, Russia. We've had this Red Sea stuff going on, and the market, trades it initially and then just ignores it. And, this was a time last week when the market sat up and thought, oh, hang on, this might be something. The US could be drawn in, and that was a lot of risk to take into the weekend. And, players decided they didn't want to hold that sort of risk going into that weekend. So, yeah, it doesn't happen often, but when it does, you just need to be aware of what to do and how to react.
Exactly that. Couldn't agree more. Right. With that said and done, let's get into some charts, shall we? Okay, so I want to start things off with the Kiwi dollar this week. We mentioned the ECB. We also have a central bank meeting down in New Zealand as well, the RBNZ due up in the very early hours of Wednesday morning. There is practically no chance of a rate move from the RBNZ this week, and there is also practically no chance of me staying up to watch the decision drop, unlike with the Bank of Japan a few weeks back. I think the central bank decision from the RBNZ will be relatively interesting, though. Previously, the RBNZ have been very clear in this higher for longer stance. In fact, according to the forecasts that they've issued, they're not really penciling in any rate cuts or even a chance of any rate cuts until 2025. But if you start to look at the data that we're getting out in New Zealand, inflation is continuing to move lower, particularly core inflation. The labour market's starting to soften slowly but surely. And activity data is starting to weaken as well. So I think it's going to be tough for the RBNZ to justify that relatively hawkish stance much longer, particularly with other G10 central banks and, of course, the Fed as well, likely to begin easing in at some point during the summer months, be that either June or July. And, of course, what central banks don't want to do is surprise markets. They like to do things very gradually, very slowly and very steadily and make sure everyone knows what to expect, rather than all of a sudden delivering a rate cut or even a rate hike and surprising market participants and causing outsized market moves. So I think the risks do point to not necessarily an outright dovish pivot, but at least a more cautious statement from the RBNZ. Markets do currently price the first 25 basis point cut for August. But if you look at the price action, I'm still bearish on the Kiwi dollar. I think there's a lot working against it at the moment, not least the situation in China and, of course, the dovish risks surrounding the RBNZ as well. We did have a little bit of a bounce last week, although we couldn't break north of the prior lows, which come in around 60.5. So I think if we can get back under that 60 figure on a closing break, and particularly if that's helped by the RBNZ turning to a little bit more of a cautious stance, then I would turn increasingly bearish on the Kiwi dollar. But nonetheless, I think it's going to be an interesting statement to read, maybe 4 hours after it drops, while having a coffee in a nice relaxed fashion on Wednesday morning.
Well, first, I'd like to congratulate you for not insulting our good cousins over that way. You've managed to make it through a New Zealand slot without doing so. So your post room can relax this week anyway. But yeah, I've not got
maybe
much,
I'll be invited to the embassy for tea and biscuits or something now.
maybe. But I've not got much to add to this at all. I think you're absolutely right. It's these central banks, making calls out to 2025. We learned that from the RBA when they were talking about 2024 before they would start hiking. That was in 2022. And look how that turned out. So, these central banks, the way their data moves, sometimes, they can be forced to move a bit quicker. But I'm certainly not expecting anything hawkish. I'm not really expecting anything dovish, but they have got their rates up. They're one of the highest in the G10 as well. So they've got a bit more impetus, if you like, to bring those rates down, maybe bring them down a bit quicker, just to normal levels, normalising rates. So I think, that's probably the slant we'll get. So, I'm on your side with this one.
Good stuff. Well, we've done the ECB, we've done the RBNZ. There's one more that we haven't done, and that is, of course, the Bank of Canada. Yeah,
the Bank of Canada, and what potentially might be another double wind for the loonie. Now, one thing that sort of slipped under the radar with all the US news and US jobs data on Friday was the poor Canadian jobs report that came out. It posted its first negative number since last August and saw the unemployment rate jumping to the highest in 2 years. Now, with the strong US jobs number and that weak Canadian data, dollar CAD tried another move of running into 136. And we've tried this several times recently, but none of them could break above that 61.8 fib around that 136.23 area. That was the fib of the late 2023 drop. That was until Friday. However, we then ran into a big old historical level at 136.50, and then we pulled back and closed back below the 136 level again. Now, with the BOC this week, I think there's a chance we may get another run into that 136, maybe something that might actually be a bit more sustainable. Just looking at their latest numbers, inflation came down to 2.1%, and that was since the last BOC meeting. So that's pretty much bang on target. They've got a 2% target, but it's allowed in a 1 to 3% range. That poor jobs report will be some food for thought for those guys. So there's a chance we do get something a bit more dovish sounding from the BOC. And if US inflation comes in hotter than expected, or even maybe just on the money, we could see dollar CAD making that significant move higher, and we could be heading up towards 138.
Yes, I think dollar CAD is actually a really interesting one at the moment. I think this week's BOC meeting is going to be very, very important because we're going to find out whether Tiff Macklem is his own man and an independent thinker, or whether he's just a bit of a puppet of what Jay Powell and co are doing south of the border in North America. As you rightly said, you look at the data, the labour market is weakening pretty dramatically, it would seem at this point. Of course, we don't want to overreact to one data point, but you've got some pretty disastrous figures, frankly, that came out on Friday afternoon. And also inflation is pretty much back around their targets at this point. And of course, as you rightly alluded to earlier, it's not inflation being at target, it's inflation getting towards target that central banks are looking for. So you look at the data and you could actually argue for a cut this month. They're clearly not going to do it. At the very least, you would say that they should make a much more cautious pivot and tee up a rate cut in June, which is when the sell side consensus sees that first cut being delivered. Will they do it? I'm not so sure. If they do, I think there's going to be some pretty significant downside for the Canadian dollar, particularly as it would come just as pretty much every man and his dog on the FOMC begins to use this line that they're in no hurry to cut, and the BOC say, oh, actually, we are in a hurry to cut. You've got some chunky policy divergence, but potentially coming into play as well.
Yeah, well, that lasted 5 minutes, didn't it? Because you went from not insulting New Zealand to insulting the Canadians now. So, sorry, Postrum, you're going to be getting letters from Canada now. But
if he's watching the show, I'd be amazed.
Right. Oh, terribly insulting. Let's move on.
Right, let's move on to hopefully something I can't get into trouble with. That is gold. I'm going to have to be incredibly honest here, and I hope I'm not alone in saying this. I've got hardly a clue what is going on with gold at the moment in terms of what's driving the market. We mentioned last week that the rally looked like it could be on relatively shaky foundations. You've got Treasury yields moving higher on both a nominal and a real basis. The dollar touched a year-to-date high last week when you look at the dollar index and remains pretty well bid as we start this week as well. Yes, things got a little bit shaky on Thursday for equities, but risk appetite overall looks pretty solid. Yet gold continues to move higher and is hitting an all-time high on an almost daily basis at this point. It seems like the yellow metal has become purely a momentum trade at this moment in time. We actually traded north of $2,350 an ounce at the Asia Open this morning. And I think this is really one where, unless we see some signs of consolidation, or we see signs that the market may have formed what we would call a blow off top, both of which seem pretty elusive at the moment. This is a bit of a juggernaut that just seems like it wants to continue moving higher right now, and certainly not one that I would be looking to step in front of and try and fade.
Yeah, I really have only one thought about what's driving this high, and that's China, and maybe China doing it as a proxy for Russia as well. They've been buyers. The only time we saw this really pausing was over the Chinese New Year when they were off, and that's when we sort of went sideways. We dipped back from, I think it was 2,200 down towards 2,150, that area. And then, it was lower than that. But when China came off their holiday, that's when it took off again and started motoring high. And you're right, you look at this, thought it might be risk on Friday with those Iran-Israel headlines. And this morning we've seen oil lower as some of those headlines dissipate. But gold just kept on going. So it is a bit of a strange one. And I haven't really got an answer for it, but I would, as I say, throw China and Russia into the hat for that one.
Yeah, that's a very, very fair shout. I mean, one thing that it doesn't appear to be is inflows into ETFs, that's for sure, because they have just completely detached from the spot gold price since pretty much the middle of January. So either folk are cashing in or they are missing out, one or the other, depending on which way you view that. If you do have a narrative that we can use for why gold is rallying, then please do pop it back in the comments down below, because at the moment your two co-hosts are really scratching their heads over this move. So why don't we move on to look at dollar MEX?
Yeah, we're going to look at dollar MEX. This one was a pair I looked at about a month ago as I was looking for longs into the big support down around the 1660, 70 area. Now, since then, Banxico finally made a decision what they're going to do with rates and decided to cut rates by 25 pips. I then took the long trade as we hit that support, which I managed to get some profit out of on the bounce until it decided to come back down and break that support. That stopped me out of the balance, but I did decide to flip it into a short when we had that break, some of which are still remaining today. Now, the key move for me in this pair was that break of that 1666 area and subsequent retest and hold of that level, confirming that break. So we're now testing the lows last seen back at 2015 down at around the 1636, 1640s. You see those lines on the chart. That's on an hourly chart, but you've really got to look left and step up to a daily chart to see all the way back to 2015 to where they came from. Now, the interesting aspect of this pair that it has ignored that Mexico might be starting its cutting cycle, which usually weakens the currency, and that the US economy is still strong with that sticky inflation. But that being said, the MEX is a commodity currency as well, so it's tied to oil, and obviously the rally there that's been happening all year may be helping a lot there. Also, we've had headlines now that Mexico has become the #1 trading partner for the US, overtaking China. So that's another positive step there for the MEX. So right now, I'm happy to stay short this pair. It pays decent carry as well for shorts, particularly while oil stays bid. And dollar rallies like this that take it back to that 1660s break area will look pretty enticing for shorts. Longs, if you want to try it from that side, they may be looking at one or both of those lower levels that I've got on my chart there to counter this move. If we do hold there, then we might find a bit of better balance for this pair and maybe some consolidation. But for the longer term picture, I think there's further downside to come.
Good stuff. Yeah, it is an interesting one. I'm, excuse me. Glad you mentioned the issue of crude, because just to take this into a bit of a broader conversation, obviously Brent north of $90 a barrel, WTI north of $85 a barrel, both at their highest since October of 2023. I was looking at some crude oil correlations, not crude correlations, this morning. And you look at the Canadian dollar, you look at the Norwegian kroner, you look at the pound, which has in the past displayed a relatively close correlation with Brent in particular. And all of them are just entirely detached. So it's interesting that it does seem that the correlation between the MEX and crude remains relatively firm and relatively tight when that relationship has apparently broken down in other areas of the FX market. But I think with this one, the trend is your friend at the moment.
Yeah, very much so. Well, I hope it is, because I'm going to stay short, and we'll see where it goes to. But yeah, certainly if we start cracking those 2015 levels, then maybe the trapdoor is really going to open.
Indeed. And I've probably just put the kiss of death on that one, mate. So if you want to go off and manage that position, then let me know. Yes. Right, let's move on to our plays of the day. Very FX heavy show this week because I'm looking at the dollar. I'm in short buying the dollar dip. The dollar touched year-to-date highs last week, just above the 105 figure in the dollar index. And obviously you can translate that into levels across the various components of the dollar index basket. I think that was just an excuse really for a few longs to take a bit of profit. The dip that we saw after that was relatively limited, holding on to the 50-day moving average and the 104 figure. I think, frankly, there is still nothing in the G10 FX space that really looks particularly attractive to me at the moment. That nothing is really trumping the US exceptionalism theme that is ongoing. Treasury yields continuing to move higher, the curve bears steepening much more rapidly than we're seeing in other DM fixed income markets. And as we alluded to earlier on, the risks tilting in an increasingly hawkish direction for the Fed, this no rush to cut mantra seemingly becoming much more of a theme and picking up some steam, while tilting more dovish for pretty much every other G10 central bank as well. So for now, I'm happy to be buying any dips in the dollar, and probably will remain so, certainly while we're above the 200-day moving average, and maybe even while we're above the 100-day as well, unless that fundamental narrative changes significantly. Ryan was obviously short of ideas for this week's show because he's given us the same chart twice.
You know what? I knew you were going to have a jab at that, even after I asked you on WhatsApp about this one. I knew you were still going to get a jab in there, but I don't care because the trade's a trade in my book. And yes, I'm looking at dollar CAD because I've sort of talked myself into this trade while I was prepping the analysis last night for the dollar CAD setup slot. So I like this trade so much, I am making it my play of the day. We've got a couple of days until the US CPI and the BOC, so I'm going to hang out for any sort of dip, something maybe down to 135.50 or the old 38.2 fib. You can see on the chart there, 38.30s, I think it's at. Something even better, if we get down to 135s, I'll be looking at, would be ideal for me to pick up a long and run into the US data and then the BOC, because I do have a strong feeling that the BOC are going to be more dovish in this one. If I don't get a dip, I will consider going in at market before the events. I'll keep a stop fairly wide, though, just to make sure I can sort of play the time between the CPI and the BOC. But I'd also judge the trade on that CPI too, in terms of whether it's very weak or how much a dovish BOC will need to pull the price back if we've seen dollar CAD drop on that. So, yeah, along dollar CAD for me, plan the two events that we've got this week.
Good stuff. And actually, just on that, a very small bit of housekeeping, because I've had an email pop up from News Squawk while you were talking to remind me of this, is that the BOC decision is now at 2:45 in the afternoon here in London, 9:45 in the morning if you're on the east coast of the US. It's been 3 p.m. and 10 a.m. for donkey's years. They switched it in March. So don't get caught out by that time shift, which I had clearly forgotten about. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer Kyriakos as well for tying things together as brilliantly as he always does. If you've enjoyed the show, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, your thoughts on what we've had to say, and if there's anything you would like us to bring up in next week's show. And that is when we will speak to you again to digest what I'm sure is going to be another exciting, volatile and choppy week in the financial markets over the next 4 or 5 trading days. So thank you very much once again for joining us, and goodbye for now.